Welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Mark Kimbrough.
Hey.
Mark, it's 10 a.m., 10:02 specifically here on November 15th. As you were saying as we were discussing in the call, it seems pretty cold out and pretty windy. Allergies are acting up. We're definitely in fall season.
Full swing. Oh, I'm shivering.
Yeah, I was in New York all weekend, so that was pretty cold, not compared to here. I'm wearing shorts here. There were no shorts in New York unless you're my son, who seems to be impervious to cold.
Welcome back to this side of the coast here.
Yes. That's good to be home. All right, let's get into the where are we for the week. And Mark, since I was out every day except for today, fill me in with some of the details here as I go over I'll take the Rip Van Winkle approach. You can fill me in if there's anything interesting happening kind of intro week. But on the week, S&P down, looks like just over 2% here on the week. Looks like the big loser is healthcare. A lot of that seems to be some election, or well, most of this seems to be, you can kind of make the story or the narrative anyway, that is kind of post-election. You're just getting a little bit more information about kind of the potential new administration coming through. So healthcare down over 5% on the week, tech down 3.5%. That's the other big loser. And then materials down just over 3%. Your winners, these are kind of the sectors that maybe would benefit the most from the Trump administration. Is energy up 1%, financials up 1.3% on the week. That's kind of more of a continuation of the trends we saw from the latter half of last week there. But overall, 9 sectors down, 2 sectors up. Only those energy and financials are positive on the week. Russell 1000 down about 2%. Russell 2000 down almost 4%. So that Russell 2000 really kind of giving it all back there. Still looks like on a month to date, Russell 2000 up 5%, Russell 1000 up 3%. And growth is underperforming value here, valued only down 1.25%, growth down 2.75%. Really, still from the year though, even though we're down 2% on the week, S&P 24.5% year to date through here, November 15th. With communication services, financials are the big winner now, 34%. Communication services just in second place there at 32%. Everything positive on the year. Kind of switch over to the bond market here. It seemed like a pretty quiet week. It was inflation week, which Mark will get into shortly here. We did see the 10-year up 12 basis points to 4.43. The long bond, the 30-year Treasury up 13 basis points to 4.61. And the 2-year, even the 2 years up 4 basis points here to 4.29. So of course, those big moves mostly on, looks like Tuesday and Wednesday. In the market, and it's been pretty quiet. Bond market has been pretty quiet here the last couple of days. But those increases in interest rates really driving that negative returns there for the bond market. So the Bloomberg aggregate index down 0.75 point. Looks like investment grade corporate bonds the loser there, as they are longer duration. That makes sense. They're down over a point. Agency mortgage is down 80 basis points or so, and Treasury is down 64. The sole winner of the sectors that we look at here is the floating rate sector, the bank loans. We'll call it flat, is just up slightly there. High yield down about 0.25 point, and emerging markets down almost a point. It doesn't seem like it was very long ago that we were sitting on some pretty good gains here on the bond market on a year-to-date basis. But now we're up 1.5% on a year-to-date basis. 10 years up 55 basis points, long bonds up 58. So kind of expect that with those pretty sizable news, pretty longer duration as we started the year, that the ag is kind of, it's a good thing it started off with a higher yield because it has kind of given a lot of that back here over the quarter. Still high yield up 8%, bank loans up 7.7, EM up 6.5. So there are pockets of opportunity in the bond market. Not really any pockets of opportunity here in the commodity market, at least on a week-to-date basis. Commodities, the Bloomberg Commodity Index down 2%. Across the board, every sector a loser. Energy down 50 basis points. Industrial metals down almost 3%. Precious metals, sorry to tell you, Mark, but gold was down. Gold was down almost 4.75%. Down at 25.66 here, so that's bad for the commodity market overall. So
it was
no
a good
winners
run
there. It was a good run, yeah. We'll see. It's still up, on a total return basis. The gold index up 23.5%. So if you hold it the whole year, you're up. But a rough kind of month to date here for the first couple weeks of November. As I mentioned, WTI crude oil, though, I was looking earlier and it was like 67.5. I was like, oh, it's 67 handle. We're like 67, almost 67 flat. I got 67.12 here on WTI crude oil. So that's really been the taking a big hit here. Also, maybe the drill baby drill idea is really trying to get those prices down. But that's it from the market side of things. So it doesn't no real all sectors are losers. So nothing really exciting to talk about here, kind of post-election.
Yeah, there wasn't a whole lot to interject on in there for the week. I mean, with the equity markets, I guess you caught it today. That's the big move today. But we're having that kind of upward trend with the rates and a little vol, but not that much movement if you look at it over a couple week period.
Yeah, and it's we'll get into it in topic of the week, kind of a little bit of a post-election ideas here. But Mark, since it was inflation week, why don't you hit on the macro stuff that happened this week?
All right, let's dive in here. So it's inflation week. Not going to start with inflation data, though, unfortunately. On Tuesday, we started with the NFIB Small Business Optimism Survey for October. Print came in above estimates, printed 93.7 versus estimates of 92, and a prior of 91.5. Hey, improvement's good, but not going to oversell it. We're kind of improving from low levels. In general, small businesses are still somewhat pessimistic. We're now the 34th consecutive month below the 50-year average print of 98. In general, like businesses are still talking about the issues they've been talking about. It's, unfilled job openings, still struggling to find qualified labor. It's dealing with the accumulated effects of inflation. But one thing that's been talked about for a number of months now that hopefully will abate is election uncertainty. Still plenty of uncertainty ahead of us, but there's a little less than there was, the month prior. So maybe that'll be some relief for the small business community. We'll see which way it goes, but at least that some of that uncertainty has been resolved. Moving forward to the Senior Loan Officer Opinion Survey on bank lending. This is a report that's released quarterly by the Fed. It's also referred to as the SLOOS report. This just tries to summarize on a quarterly basis the lending standards and demand for loans by various banks across the country. And we'll break this down just a few components for a quick summary. Looking at loans to businesses, the lending standards basically unchanged for large and medium firms and a little tighter for small firms, but across the board, there's weaker demand for we call commercial and industrial loans. Going to another subsector here, we got commercial real estate. In general, we got tighter lending standards and weaker demand across the board for all CRE categories. And the last one is households. I'll only touch on two categories here. We have, residential real estate loans. You have unchanged lending standards and weakening demand or weaker demand for most categories of residential real estate. And you have tighter standards and unchanged demand for credit card loans. Now, I'm going to focus on that last one. They have a special question in there where they're focusing on credit card loans. And again, while they reported it, the demand is basically unchanged. They noted that the demand in Q3 was higher than it was before the pandemic, and also that demand is expected by banks to increase. Now, I'm going to kind of qualify what demand means. That means demand for new credit cards. That means demand for a higher credit limit or increasing your utilization of your existing credit limits. But in general, banks are saying over the next 6 months, they're expecting increased in borrowers spending. With the most common reason kind of being intuitive, it's they expect there to be increased demand, like via increased purchasing and spending needs. They want to spend more, so they got to borrow more. People are still having decent wage growth, but there's an expectation that people will pull out the credit card and continue to keep the consumer going. And we'll get into that with retail sales later today. Let's move forward. Actually, so inflation week, we get Wednesday, the first bit of inflation data. We get CPI for the month of October. All the prints, we look at the month over month, year over year, core headline. They came in line with estimates. Let's run through these numbers real quick. We have month over month CPI coming in at 0.2%, right in line with the prior. You have the core measure month over month, that's ex food and energy, that came in at 0.3%, right in line with the prior. The year over year figure for the headline came in at 2.6%, a slight increase, 0.2% increase from the prior. And the core year over year number came in at 3.3%. Again, right in line with the prior. Sorry, I have to repeat that so many times. Look, it's the year over year number jumped up a little bit. You had 8 bips rolling off the calculation, 24 bips rolling on. Not a lot of movement there. It's not a lot to be concerned with. If I had to give a quick summary of the CPI report here, I don't think it really does anything to materially dent the disinflation narrative. That it's supposed to be a long and bumpy ride, and has been a long and bumpy ride. But I'll dig into the details a little bit here. Let's start with the month over month. And I'm actually only going to talk about the core numbers. The food and energy kind of net themselves out materially for the purposes of this discussion. So in general, we're looking at core. It's dominated by services right now. The month over month, core services, we actually had a slight bit of positive contribution from core goods, but core services dominates the discussion, and shelter is the most, I'd say, important category people have talked about. On that note, and digging a little deeper into shelter, there's a constant call for shelter to come down, but it's not going to zero. So how much more can we actually ask of shelter to contribute to this disinflation discussion narrative? I'm going to spit out a couple numbers here, just a little thought experiment to kind of give some context to how I'm trying to think about these numbers. Over the last 6 months, shelter has averaged a contribution of just shy of 16 bips per month to core CPI. So that's 16 bips. Pre-COVID, I got data going back to 2012. I ended at 2019. Let's just call it just shy of a decade's worth of data. You averaged about 10.5 bips per month. So if I was to assume that's a fair trending average, and that you can argue with that, but if I was to assume that, you could expect core CPI to normalize by about 5 bips per month, or let's annualize it and say 64 bips per year. So let's take some numbers here and say we had 3.33% on core CPI. If I was to trim that by 64 bips, that brings me to 269. Keep that number in the back of your head. Over the last 20 years, core CPI year over year, it's about 30 bips hotter than core PCE. So let me take another 30 bips out of that number and say that 2.69 gets to 2.39. That's not that far away from the Fed's target. Again, that's not saying that that's all of those were the most fair of assumptions, but they're rough figures that kind of show you why the risks of balance, between labor and inflation to some extent. So that's just wanted to highlight those numbers on the month over month basis.
As you were talking about it, I was thinking, well, the Fed's targeting 2 and the shelters, you said 64. Did quick math in my head, 50. I was like, we'll probably settle in at like 2.5%, and the Fed will probably be happy with that. So we're getting there.
Exactly. And that's, but one of the things we've had that's helped us on that road is we've had deflationary goods. If you look on a year over year basis, you still got inflationary core services and deflationary core goods. We did just get back-to-back months with positive contributions from core goods. Who knows? We're not going to get negative contributions forever. Eventually, those goods prices will go up. But again, thinking about core services, there's 3 big categories. We talked about shelter already, but transportation services and health and medical care services are two other large contributors. Those normalize a bit. Let me give you one little detail here before we move on to the next topic. Insurance makes up 3.6% of the CPI basket, but it's contributed 48% to the year-over-year core number. That's, it's punching above its weight class. So that won't continue forever. There's a lot of still things that can normalize here to bring inflation back to target. So let's leave that behind and say again, I don't think the disinflation narrative is dented. It wasn't the best of prints, but it wasn't the worst either.
Yep.
On Thursday, we got PPI coming out for October. These were not as rosy as the CPI numbers. These all exceeded estimates. You had the headline month over month coming in at 0.2%. That was in line with estimates, 0.1% higher than the prior. The core, I'd call that ex food and energy month over month number, came in at 0.3%. That was 0.1% higher than the prior, 0.1% higher in estimates. That brings the year over year numbers. The year over year headline number increased from 1.9 to 2.4%, and the core number increased from 2.9 to 3.1. Look, keep getting the focus on core goods on core PPI. We had a local low of 1.8 back in December of 2023. And that's kind of where we averaged pre-COVID. That was 1.8 going back, I think, to 2010 data or so. That was kind of the ballpark that we were in. Since then, core PPI has come back and settled in the kind of mid-2s, low-3s range. It's not helping as much on the disinflation narrative, but, the data is where it is, and we'll see how that continues to progress. CPI is doing better. Also on Thursday, we get initial jobless claims for the week ending November 9th. This came at 217K. This is 3,000 below estimates and 4,000 below the prior week. This was actually the lowest print we've seen since May this year. And that brought the 4-week moving average down to also the lowest we've seen since May this year. So we're, about a month removed from Hurricane Milton. Some of this is to be expected, but it's nice to see those numbers settle back down. Unfortunately, not seeing that on the continuing claims side as much. For the week ending November 2nd, That printed 1.873 million. That's just 11K lower than last week. The 4-week moving average increased by 1K. We're 15K below the peak we saw on October 11th. All in all, these numbers have not settled back down. And that's a little more concerning in terms of at least expectations I was having. But nothing to write home about it yet. I mean, they're not taking off and got a gentle uptrend because of a couple storms. And maybe some of those people haven't been able to catch back on yet. So we'll see how that data develops in the weeks to come. That brings us to today's data. And the retail sales data was actually quite entertaining. I'm going to spit a handful of numbers here at you. This is 0.4% was the headline print on a month-over-month basis, slightly exceeding estimates, but decelerating from the prior prints of 0.8%. The ex-auto and gas number printed at 0.1%. That was also below estimates, and it was 1.1% below the prior print. And retail sales control group that feeds into the GDP calculation that came in at negative 0.1%, and that is 1.3% below the prior print. And if I was just to tell you those numbers, it sounds like a lot of deceleration. I'll dig into the details to show you why that's not the case. Actually, no, I'll just state it on its face. The priors were revised up sharply. It made the growth targets quite a bit harder to be met for the estimates this quarter, or so this month. So looking at some of these figures, you had the headline retail sales number. It printed at 40 bips on the month versus a prior at 84. Its 6-month annualized rate is running at 4.7%. I'd say that sounds quite healthy. That's, about in line with the 20-year trend. A little better, actually. The ex-auto and gas figure on a 6-month basis is running at 5.85%. The control group is at 5.23%. These are all hotter than their 20-year annualized averages. Retail sales remain strong. I mean, that speaks to the thoughts of ongoing credit card spending. That speaks to, we've had pretty strong consumer credit growth over the last 1-2 year period. We talk about that periodically here on the show. All in all, retail sales, this is, while the numbers for this month were not booming, if you net out kind of the trend of what we've been having, retail sales continues to be pretty strong. The consumer is not pulled back. If this negative 0.1% for the control group persists through the end of the quarter, hey, we'll talk about that, but that's not where we're at yet.
I think, Mark, you and I have different definitions of what entertaining means, but you do you.
That's fair. I love the revisions. It's just when you see that your prior turns from what was the numbers? So I'm giving this
like a point. Like the headline was from 0.4 to 0.8.
Yeah,
so it doubled.
You doubled, and so I guess all that money just showed up. All those sales suddenly showed up. So, so on Friday we finish up. We have import prices. Not much to write home about here. These are a lot more volatile than the CPI and PPI numbers. The month over month came in at 0.3, higher, 0.4% higher than estimates. The year over year came in at 0.8. It actually increased from the prior of negative 0.1. This year over year number for import prices is going to get volatile. We have a lot of big numbers on the negative side rolling off through year end, a lot of big positive numbers to start the year. We're going to see this jump up and down potentially. So, we'll leave that there. And then industrial production on Friday, we got that, and capacity utilization. These are manufacturing figures. Won't dig too deep into these. It's the manufacturing kind of recession continues. Industrial production decreased by 0.3% month over month for October versus a prior of negative 0.5%. And capacity utilization came in at 77.1%, which is below the prior of 77.4. So just, again, weak manufacturing data. And that wraps up our inflation week here.
All right. Thanks for that, Mark. If we look at how the market has reacted to kind of the inflation data, we were really sitting at like an 85% chance of the Fed cutting another 25 basis points in December. And then we're down to, we'll cut to the chase, down to 62% here today. Actually pricing in only 3 cuts between now and the end of 2025. It wasn't that long ago. We were pricing in 5 cuts. So a pretty big move there. And really, the big movement over the short term anyway came from Jerome Powell was speaking in Dallas yesterday. And he said, quote, "The economy is not sending any signals that we need to be in a hurry to lower rates." And then he also said, "The strength that we are currently seeing in the economy gives us the ability to approach our decisions carefully. Going slower, if the data tells us to go a little slower, seems like the smart thing to do." And I mean, I agree with him. It doesn't really seem like we're not, we had that little bump in August, or speed bump. And that kind of got people worried that we're going on a trajectory higher odds of recession, but it doesn't really seem like that's really, at least when we're looking backwards, affecting the economy, and we're not at a place yet where we should be too worried that the Fed is the economy is slowing down so much that the Fed needs to cut rates. Certainly slowing down, but not at a pace that the Fed needs to be too worried about it. And of course, there's a lot of unknowns in the future, and as we get more information, that will certainly help us determine whether the Fed needs to cut rates a little bit more, or whether they feel comfortable with where they're at, and keeping their options open. I think it's really Jay Powell saying we want to keep our options open. We don't really know what's going to happen, so no point in kind of keeping that forward guidance going where they're going to cut rates, at a gradual pace, but really be much more data dependent.
Sounds like such a sober take, and it's welcome.
Yeah,
very welcome.
Exactly. With that, though, let's get to our question of the week, or topic of the week. We did get a question that I talked about last week from a listener, Rich, and he said that he was listening to Mr. Gunlock speak. He said that that we're long 3 to 5 year bonds, and then we're kind of short long bonds. Is that a shift? The short answer to that is no, and I'll touch on that again in a second here. But he also asked, given the steep rise in 10s and 30-year Treasury rates, are we approaching a Liz Truss moment earlier than anyone expected? Is that the risk we are underestimating the return of inflation and money printing? Gilt rates have spiked and Bund Treasury spread has increased. And I think that, those of you who don't remember Liz Truss, that was was she Prime Minister in England, and is she going to last longer than the head of cabbage? That was that's the visual I have. And it was really because, she submitted a budget, or her team submitted a budget, and it was like the bond market reacted. The bond vigilantes reacted.
Often referred to vigilantes.
Yep. And, that's really what caused the rates to spike, and that caused the LDI crisis in England. And that really, that was the end. That was the beginning or the end of the end for her. And so are we getting closer to that? And that's a lot of the questions. And I guess we were at a place where at DoubleLine, a lot of people were asking us about the election, pre-election, what's going to go on, what's going to happen. And we would just point to the fiscal deficits and saying, it doesn't matter who wins. It's bad for the deficit. It's going to cause potentially cause problems. It's going to get us to a place where the bond vigilantes come in here in the U.S. and longer term rates rise. And that's why we are, I don't want to say we're short the long 10s and 30s. We're underweight 10s and 30s versus like the Bloomberg aggregate index. And it's interesting because we just put together a piece. It's getting approved right now. We didn't put it together. Bill Campbell, we being DoubleLine put it together. Bill Campbell is the one who wrote it. It's going through the process here, and it should be out shortly. But it kind of talks a lot about the economic impact of the U.S. election, and I like the format that he put together, where it's like, here's inflation is obviously a big topic. Here's a thing that could be bad for inflation. The very headline, tariffs and tighter immigration. Those are bad for inflation. But it doesn't just say, okay, here's all the bad things, but here's the other ways that the inflation there's potential offsets to inflation. Some of it is that, we've been through this tariff war, if you want to call it this, to trade war before. So the other countries are maybe a little bit more prepared for it. They certainly are more aware of that actually happening. So there's that potential there. And so really, talks about inflation, the fiscal impact, and then DoubleLine positioning. And so I think that this is a good piece. And if anyone, you can hit us up, minutes@doubleline.com, and we'll make sure you get a copy of it if anyone's out there interested. But it's a good piece and kind of covers most of these questions that Rich talks about, and questions that are certainly out there in the ether that people are worried about. And obviously we don't know kind of what's going to happen, but people are worried about kind of the next Trump administration and what their impact is going to be on the bond market and inflation, and what's the Fed going to do. And so with that, Mark, next week looks to be a very, very quiet week. And then we got Thanksgiving. So the next couple of weeks should be pretty quiet here from the macro standpoint. But would you give everyone the, looks like three data points that are going to happen next week?
When I just looked at the calendar, I almost thought it was Thanksgiving week, and it came early because it seems so light.
Yeah, me too.
It's, but the first thing we're really going to look at on the week here is actually not till Thursday, and that's our weekly initial claims and continuing claims. No estimates out yet, but we'll see if the continuing claims can settle down at all a little more. And then on Friday, we get S&P Global's PMI figures. That's the U.S. manufacturing and services number. Manufacturing is estimated to be at 48. That's a 0.5 point decrease from the prior, while services is estimated to remain flat at 55. This is, ongoing services strength and weakness in manufacturing. So we'll see what the details give us there. But those are the big points for next week's economic calendar.
I guess, next week there's no big points Monday, Tuesday, Wednesday, and then the following week, we only get I guess Friday's a business day, but we won't be doing a podcast on Friday because it's a very short, quiet day.
It's post-turkey day.
It's post-turkey day. Everyone will be I guess it's Black Friday, so everyone will be shopping. All right. Well, that wraps it up for the week. I'd like to thank everyone for listening.
Yes, thanks to our listeners out there today on DL Minutes. Hit us up on the X at DL Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Don't forget, our YouTube channel is youtube.com/DoubleLine Capital. And Jason's doing a good job getting charts in there. If you're not listening to this live, you want to listen with some charts, some visuals, go hit it up there on the YouTube there. We also have put up some new videos here. We got Ken Shinoda on Monday on Bloomberg TV. We had Robert Cohen talking about equity versus credit markets. That was from a couple days ago. And then we have the most recent episode of Channel 11 talking October markets and the red election wave. So a lot of good information up there on our YouTube channel. Again, youtube.com/DoubleLine Capital. Thanks for tuning in. Hope everyone has a great weekend.
Yeah, thanks everyone. Try and stay warm out there.